We've talked this hour about how inflation is cooling down, but what about the consumer spending engine that powers most of the U.S. economy? Joining us right now with his perspective is Bill Simon. He's former Walmart U.S. CEO. And Bill, where does the consumer stand right now?
Yeah, I think the consumer's been as resilient as they possibly could be. You know, they tend to figure things out. And, they've been battling with really, really aggressive food inflation over a 2-year basis. Housing costs, rents are really putting pressure on them, but they're figuring it out. You know, they're shopping deals. By all indications, Black Friday was pretty good. Now it's quieted down after that, but they're figuring it out.
Is this a situation where consumers are going to make it through the holiday shopping season, but then really kind of gasp and sputter when it comes to spending in the early part of next year?
Yeah, by all indications, I think that's what's going to happen. Christmas is going to come. They're going to take care of their families. They're going to do it really judiciously. I think, it's going to be a game of chicken with the holiday as it comes up, waiting for the deals to come at the last minute. And I think that last weekend before Christmas will be really good. And the Christmas season will be, generally good, acceptable. And then I think, January, February is going to slow way down. There's no reason to spend money in January and February. And I think the consumer is going to take a wait and see attitude, maybe lick their wounds a little bit and watch and wait.
I think of all of the commentary that I've seen recently, what I've heard from Walmart may be most concerning. Just the idea that their consumer is feeling the pinch, too, because you would think that Walmart actually is typically a beneficiary when we head into tighter times for consumers. You have consumers who trade down, who make sure that they are trying to get the best, to stretch their dollar as far as they can go at Walmart. What have you heard and what do you take out of it?
Yeah, I think that's a concern. The real key piece is that the cost of living, the actual cost of living, primarily food and housing, are really taking a big bite out of the consumer. And that's, a larger percentage of income for the middle and down segment of the economy rather than the middle and up. And that's Walmart's customer base. And so the more they spend on food and rent, the less they have for discretionary things. Now, I think to a certain extent that plays into Walmart's strength because of the size of their food business, but doesn't really bode well for, the real general merchants out there.
So what could change things? Because, again, we're trying to figure out if the consumer spend when it comes to things like travel dies out. We know that they haven't been buying big ticket items for a while because they bought so much of that during the pandemic. Maybe they pulled forward a lot of sales. What do you think the next iteration of the post-COVID consumer looks like?
Yeah, I mean, the trend has still been, and that still seems to be strong. It's still been experience over items. Your point is bang on. Everybody bought everything they could and, shipped it to their homes during COVID. So, they've got 8 pairs of shoes that they haven't opened yet, kind of waiting for them to, the other ones to wear out. And it's going to take some time to cycle through that. That's freed up a little bit of discretionary income for things like dining out and travel. And I would expect that to continue. The real key is going to be what the Fed does with inflation abating. I think we're past peak. It's still too high, but, starting to moderate. If the Fed starts to, ease interest rates, I think then the consumer will respond back again.
If they don't, and let's talk about this, because the pinch on the consumer really hits over time when you start talking about the higher interest rates that they're paying on their credit cards, higher cost of being able to buy big ticket items. All of those things really add up, and that can see the consumer slow over time. In your experience, Bill, how does a heightened interest rate cycle really impact on the stores level?
Yeah. I mean, it really just sucks away discretionary income. The amount of credit card debt, particularly that the consumer has, particularly the middle and lower ends of the consumer, is really staggering. And $200 or $300 a month in interest on a credit card is the difference between buying something and not buying something. And so as interest rates remain high, it's very difficult for there to be any, discretionary income that starts to move some of these categories that have slowed over the last year.
So we spoke with Roger Ferguson. He doesn't think that the Fed will lower rates till the latter half of next year unless there's something really wrong, like the economy takes a bigger hit than anticipated or something breaks in the financial system. If that's the case, if they don't lower rates till the second half, how do you see this playing out?
Yeah, I'm probably a little earlier than that, spring to summer for me. I think inflation's the problem that has to be dealt with. And I feel like the Fed's doing what they need to do. You know, we recover from recessions pretty frequently. You can sort of look back at the calendar and they're there. And we know how to get out of a recession. We don't see this kind of inflation, 20+% food inflation on a 2-year stack basis very often. The last time was in the 70s. And it's difficult for us to get through them. So I think it's prudent that they focus on that. I think we're through most of it. We've still got to let some of the wage inflation cycle through. And I think that's the kind of what we're waiting for. I would think that maybe by the spring or early summer, we can move into that, which is why I think the first half of the year might be a little slow from the consumer's perspective.